9 a.m. in Shanghai, Shenzhen, and here in Hong Kong. You're watching The China Show. I'm Yvonne Man.
And I'm April Hong in Singapore. We're counting down to the open of markets in Greater China. Our top stories: oil holds on to gains and Asian stocks slip after President Trump makes new demands on Iran, dimming hopes of a quick deal to reopen the Strait of Hormuz. We're watching tech stocks in the region as Nvidia teams up with Wall Street investment giants to tap $500 billion in AI infrastructure funding. Also on the program, mainland investors jump on Unitree's Shanghai IPO, with the retail portion more than 5,000 times oversubscribed. And we take a look at the hospitality sector, hearing exclusively from the CEO of Hong Kong and Shanghai hotels following first half results that swung back to profit. Take a look at the market reaction for now, following on from these Trump demands on Iran. You know, that's making these hopes of a quick deal on the Strait dwindling in that regard. We are seeing, though, Brent hovering near the 88 handle, those pairing some of the earlier gains against the backdrop of the pressure that's coming for treasuries, particularly for now Treasury futures on that 10-year bit of the curve. We are, of course, tracking dollar yen. We have been seeing the Japanese currency reversing a lot of those intervention gains. Flip the board, take a look at what we are expecting when it comes to U.S. stock markets. Of course, given how there had been earlier a bit of caution in terms of futures, this is a bit of a turnaround, following on, of course, from the plans that have been unveiled for financing for AI infrastructure spending from the likes of Intel, Nvidia. We're going to talk a bit more about that in just a bit, but that caution is quite pronounced when you look at the Kospi. Okay, maybe not as much as what you typically see with those big swings on the Korean benchmark. Interesting that you are also seeing the TAIEX down a touch. Just for the board again, take a look at some of the chips that are in focus against the backdrop, of course, of those TSMC monthly sales. You did get that rise for the month of July, and that is echoing, I suppose, that strong AI hardware spending and demand. And we're seeing, of course, the likes of the chip stocks overall, they are in focus following what we've heard from Nvidia. Take a look at the setup for China today as well. Of course, we saw the Hang Seng outperforming mainland stocks. We are watching a couple of other things, including yet more voices talking about how the proposed U.S. ban or reported U.S. ban on Chinese data center components into the U.S. and how that might not materialize. We hear from the likes of B. Riley after, of course, that call from Bloomberg Intelligence already last week when that bit of information came out. This is the setup coming into the session today, Yvonne.
Yeah, that's going to be a big one for the Chinex as well, given that some of these stocks, especially some of these Genji, Inolite, and the like, have been beaten up based on some of these geopolitical tensions, right? But maybe things are softening a little bit on that front here, which could be a good boost for the Shenzhen here today. But yes, we have to bring it back to our top story, which is, of course, this Nvidia deal, right? We are talking about a price tag, well, of $500 billion when it comes to this financing package with some of these big banks. You got to wonder, Avril, is compute the new asset class?
Yeah, making it an investable product, right? And worth noting as well that this is going to be third party. So it's not going to be sitting on Nvidia's balance sheet. Aside from that, just look at the names that are in the mix, right? All the big private market firms, BlackRock, Blackstone, KKR, Polo, even Goldman Sachs in the mix. And as we've heard from Jensen Huang, you know, he pretty much went to them with the idea and nobody said no. So very interesting in terms of what this means for the AI infrastructure build out. Of course, as we highlighted earlier, this is coming as Intel is looking at a share sale as well, could be to the tune of $15 billion. But it's also looking at something towards $20 billion, sources say. And this would be the first time, this first share sale since the early 1970s. So quite something as well. And of course, it's not just Nvidia, not just Intel. We're also watching the likes of Anthropic, a $9 billion deal with the likes of Macquarie as well as GIC. So just this idea of how much financing is required for the AI infrastructure build out, Yvonne.
Yeah, and it continues to really add on, right? When you take a look at what TSMC numbers suggest as well, they're talking about 45% a rise in terms of monthly sales. Does in some ways signal this AI demand is sustainable in some ways? You square that with, of course, this financing on all the headlines we've been seeing across some of these deals. It certainly leads to a lot more focus back on the attention of where to next in this whole AI trade. Let's bring in Felix Wang now, Managing Director of Global Technology at Hedgeye Risk Management. Felix, it's great to have you back on the program. Let's start with the Nvidia news here. I mean, $500 billion certainly is eye-popping. I'm just wondering what went through your mind when you saw that headline?
Yeah, it is a huge number. Thanks for having me back. There's a reason why Jensen wears a shiny, expensive leather jacket. He's able to see far ahead and exert control over the AI game and competition. And right now, a new part of the game is about financing, lowering the cost of capital, lowering the financing constraints for their customers. That could be another structural advantage for Nvidia. So the way I'm thinking about it is this: if Nvidia and AMD both have similar compute and TCO economics, but Nvidia's customer wants, say, for example, 10 billion of compute, and they only have 1 billion of EBITDA, so that means they have to borrow. They have to borrow billions of dollars of financing at an attractive rate, and Nvidia can facilitate that lending. So to me, that's an advantage. In effect, they made Nvidia's product cheaper without really cutting GPU prices. Again, it's about controlling of the game, extending their moat. But I also see this financing layer, if you will, as a double-edged sword for Nvidia, because yes, it can absolutely extend the hyperscaler investment runway by allowing them to borrow at attractive rates, but it also makes future demand kind of more sensitive to credit conditions, credit volatility, and raises a lot of questions on what we consider to be real demand. So this is why, Nvidia, if you look at their 5-year CDS, they jumped today, the most in 2 weeks.
Yeah.
Financing can pull forward demand and raise the risk of overbuilding. So it is a double-edged sword here.
Yeah, I was going to ask you that because it seems like these financing deals are becoming more of a credit story than a stock story, Felix. Given the CDSs have widened, the spreads there, I mean, do you think the stock can continue to rally if we continue to see that angst in the credit market?
Yeah, I mean, I think, again, this financing layer is not really new, right? So these financing deals haven't been unique. We saw something very similar to SPV financing last year, and with the same Wall Street giants. Apollo Blackstone also struck a deal with Broadcom for Anthropic to pay for TPU. So this isn't a unique deal, but the scale, as you mentioned earlier, 500 billion, and what you guys mentioned, nobody turning down Jensen. I can't remember the last time a company turned down Jensen. If they did, they probably don't exist today. But to answer your question more directly, look, financing is now part of the story. And NVIDIA CDS is not just their CDS. A lot of these AI winners, AI infrastructure winners, and AI beneficiaries have seen CDS pop because people not sure, about the whole story of AI giants raising debt, borrowing money to fund massive AI infrastructure spending. So that's going to be a key question going forward.
Yeah, I suppose to your point, Felix, it makes more sense for Nvidia in terms of this being turned into a credit market or financing story, so to speak. But talk to us about net, where do you think this leaves Nvidia's stock? And what will be the next catalyst? I mean, we've been seeing it, it's becoming a bit of under pressure of late.
Yeah, today in particular. But look, I think, when they report earnings, you can't just look at the typical revenues, margins, CapEx figures anymore. You really need to dig deeper now into, say, looking at accounts receivables, maybe into their investments, maybe looking into the, the footnotes when they talk about commitments, contingencies, because now people are looking at Nvidia as a financing lender, right? So all of these metrics now matter in understanding, what are they going to do with their free cash flow, how much investments they're going to make for third parties now. And by the way, their free cash flow is not infinite. Right now, my model is around 100 billion, and they're going around making a lot of deals that's higher than that, right? So people get worried, how can Nvidia finance this? Well, they have to raise money. All of this affects sentiment on the stock. But generally speaking, we have a really good regression model to model Nvidia's data center revenues for the quarter and guidance. It has a 97% R squared. And so far, the AI trade continues to trend higher for Nvidia in terms of their Rubin demand and so forth. However, I just came back from a memory storage conference out on the West Coast, and they were talking about trying to reduce GPUs through innovations in memory architecture because GPUs, HBM, they become too expensive. So that's also weighing on sentiment here on Nvidia.
Interesting. When you see a deal like this and all these financing deals have, it seems like it's almost like a daily sort of occurrence now, Felix. What's the read-through for the semiconductor sector? And is this just more signal that, is this just going to continue to fuel growth? Or do you think it's the opposite, where we're just dealing with some very, very expensive bills coming up?
Yeah, I mean, at the end of the day, it's about where do you feel about the AI cycle? Do you see GPU utilization improving? Do you see AI monetization improving? All of this is critical for more investments in semis, more investment in capital spending, more investment in AI infra. And financing, going back to the our main topic today, can help facilitate that. But what if the opposite is happening? What if we get into a situation where compute is overbuilt, you have weak AI monetization, you have weak GPU utilization, wider credit spreads? That could turn into less demand for semis, less demand for GPU purchases, less demand for memory, HBM, and so forth. So less demand for networking, interconnect. All of these things that people got juiced up on for the AI trade goes into reverse. So right now we're not saying the latter. We're still seeing good momentum from a lot of the a lot of my contacts in the supply chain, as well as how we track token data, right? Token spend, developer spend, all of this is very important to drive the AI trade higher. And don't forget the two major AI labs, particularly in the US, Anthropic and OpenAI. A lot of these deals are to facilitate their growth, right? Because they're not investment-grade companies. They may not be able to get attractive financing, so they need help. And Nvidia is a great sort of bridge to that.
Yeah, which has also raised the issue of how this is making the circular nature of the investing and inflating some of the demand for AI. But Felix, you raise an interesting point. There could still be the idea of we're building more than we actually need. What is your sense of what the earliest warning indicators, I guess, will be to know that we are in that stage of the AI build-out?
So by overbuilding, what I mean by that is you start seeing AI monetization really turn. Whether it's AI growth, whether it's GPU utilization, whether if it's through these rental rates that we see from GPUs and even CPUs, if they start to turn south, particularly for Blackwell chips, particularly for upcoming Rubins, that's not a good sign for building out this whole AI ecosystem. I mentioned earlier, overbuilding. What if token growth is not 10x, 100x what people think in the next 5 years? We have a really good read through our token database, tracking about 800 LLM models globally from both US and China. So we keep a close eye on token growth to make sure it's at a good level to sustain higher and higher CapEx spending and investment spending for the AI guys. So a lot of data out there that we can track to kind of gauge whether we could be sort of overbuilding at the top of the AI cycle or not. But I'm not saying that currently.
Felix, I know you're tracking and you also cover China tech. We have Tencent earnings coming up later on this week. It's interesting, right? You're starting to see investors more comfortable going back into sort of the large cap tech. in China. There's some traction when it comes to AI. We just talked about WorkBuddy from Tencent. It's become one of the most popular AI assistants for the workplace. And really, in some ways, outperforming some of the pure plays. I know we had you on a few months ago when it came to your short position in Zhipu. So I'm just wondering, how are you looking at the space right now?
Yeah, I mean, it's not just Tencent, Alibaba, some of these forgotten, legacy tech giants in China is getting a big boost. I do see a momentum reversal trade going on globally. So a lot of the, AI momentum companies that have had triple-digit gains and so forth have reversed as people think about, what is fair valuation, what if AI sentiment normalizes a little bit here? Well, then the value companies benefit, for example, Tencent and Alibaba. I do see right now the LM landscape is becoming a lot more fierce, particularly on pricing. I've explained this before with DeepSeek. You got to keep an eye on DeepSeek because they are the cost bottom. But interestingly enough, last week they decided to raise prices. We're not sure by what amount, but this is an interesting signal here because if DeepSeek starts to focus on monetization, maybe others will follow as well. ByteDance, Tencent, Alibaba, Zhipu, and others. And it may actually lead to a more benign environment for LLMs. But again, very little details on what DeepSeek plans to do with their price increase. But that was a surprise to me.
Maybe we need to really see more meat on the bones in terms of what their business models are actually really going to look like at the end of the day, what these Chinese players are converging towards. Felix, it's great to have you. Thank you so much for taking the time today. Felix Wang is Managing Director of Global Technology at Hedgeye Risk Management. Now, still ahead on shows, we speak exclusively to the Hong Kong and Shanghai hotel CEO Benjamin Vuchot about expansion plans after the group returned to profitability in the first half. And of course, we're counting down to the open of trade in Shanghai, Shenzhen, Hong Kong. This is The China Show.
All right, we've been checking, of course, what's been happening with crude prices here. Of course, we've gained about 9% really in the last 3 sessions or so. We're holding on to some of those gains here today with Brent hovering around that $88 mark. Well, President Trump is calling for Iran to pay compensation for damage and deaths caused in conflicts across the Middle East. The sweeping demands were made in response to Tehran's request for reparations for the U.S. and Israeli war. And that also sparked a rally in oil prices, of course, that have left stocks wavering, bond yields climbing, and once again, adding to some more inflation angst ahead of that U.S. CPI print coming up later on today. Let's bring in our managing editor, Jill Deeses, with the latest, of course, more sort of a hardline stance coming through from the U.S. overnight.
Yes, that's right, Yvonne. I'll just read you a bit from this Trump statement saying, I'm likewise demanding compensation from Iran for all the people that they have killed and gravely wounded with their roadside bombs in many conflicts. Additionally, compensation should be paid to the families of the hundreds of thousands of innocent protesters that Iran has killed over the last 50 years. So, I mean, we're talking about really, demands that Tehran is never going to accept here, right? I mean, we're talking about just an escalation of rhetoric from the United States right now. Obviously, we've also heard Iran reiterate their own requests for compensation, they say, dating back to when this war broke out back in February. So I think, you're looking at that upward pressure on oil prices. I mean, we're at the point now where, sure, we had those interim peace negotiations that, happened back in June. That feels like a lifetime ago at this point. I mean, it just seems like a lot of this stuff coming from these hardliners is just inching toward, what does a negotiation actually look like that results in peace?
Jill, can the U.S. president afford to ramp up the rhetoric in such a manner, given how we are inching ever closer to the midterms?
Well, Averill, I think, what you're looking at is some frustration from the U.S. president. He has said in recent days that, one tactic that the United States is kind of looking out for is whether there's a way to put economic pressure on Iran, this idea of a lasting conflict that ultimately inflicts enough pressure to have Iran back down. I mean, I would just point to the fact that we haven't really seen that come into the calculus over the last several months. And yes, you do have to wonder, when you've got a U.S. president that is facing down the midterms later this year, a lot of those concerns, domestic concerns within the United States about upward pressure on prices, does that actually, enter the calculus that the U.S. president is thinking about right now? Perhaps, but again, I think you've seen so much sort of push and pull in this relationship just over the last couple of months, the ups and downs, and how these negotiations are looking. That it's hard to see, where this actually goes, whether this just continues on some form of escalation, or whether there is some kind of an interim deal that they're able to reach here.
Okay, Jill Deesa, our managing editor on the latest when it comes to Iran. And of course, we'll take a look at what comes to the pre-market. Hang Seng is opening up now. We're inching ever so closer to that 26,000 level. So we're seeing moderate gains across the board right now. Futures are in the red this morning, though. We are looking at that 10-year yield trading below at 1.7, which was because of some weaker data that we got out of China. But 674 for the renminbi here this morning. We got plenty more ahead. This is Bloomberg.
Couple of things on the agenda, including the focus on biotech stocks that have been on a winning streak since last week, but also watching optical names, given how we're hearing yet more voices on how this proposed ban or reported ban might be unlikely from the U.S. on these Chinese data center components. Of course, watching copper-related stocks as well, as LME copper trades at a record level. We have been seeing, of course, that delay on the decision on copper tariffs. That is one overhang for the markets. Maybe the metal will face this sudden repricing or the risk of that in either direction. Aside from that, of course, we have been watching Unitree overall, given how that Shanghai IPO has been 5,000 plus times subscribed, Yvonne, the focus on physical, embodied artificial intelligence.
Yeah, I think there was some stats that came through about China really dominating when it comes to the humanoid robot sort of space there in the industry so far. So certainly a lot of interest in Unitree coming up with that listing in Shanghai. In terms of the pre-market, we are seeing some decent sort of gains across the board when you look at HS Tech, Hang Seng, as well as the H-share market here. Coming at a time we are seeing flaring intentions in Iran, and certainly that does lead to a lot of inflation fears ahead of that US CPI report. The tech trade is in some ways we're seeing a little bit of dour sort of sentiment in Korea and the like, but it seems like Hong Kong, as our guest Felix Wang said, right, this momentum reversal back in favor for some of the large cap tech certainly is something that he's been watching very closely ahead of Tencent's earnings coming up later on this week. HS Tech catching a slight bid here this morning. As Averill mentioned, right, we're watching very closely the likes of Zhongzhi Inolite, which some of these stocks have been hit quite hard given the recent concerns around U.S.-China relations and really the like that B. Riley says that this component ban seems unlikely for China. There you go. You are seeing a bit of that rebound here for the likes of Zhongzhi here this morning. We're also watching those chip stocks, of course, after that big, massive financing package from Nvidia and some of these Wall Street banks. The chips lower this morning. The open is next.
Welcome back. You're watching The China Show. We're counting down to the open of markets, and maybe we get more of that outperformance of the Hang Seng, or particularly the mega caps versus some of the hardware stocks, although the read-through might be complicated a little given how optical-related names are also in the spotlight today, against the backdrop, of course, of yet more signs that, the proposed ban, reported ban, might not be implemented, as some of our colleagues have already been highlighting since last week, given how this could be, detrimental to the US hyperscalers. It makes things a bit trickier for them, given this disruption. That is something else to watch out for as we keep an eye on the market open, Yvonne.
Yeah, was this all just kind of a bargaining chip ahead of those big key talks happening between U.S. and China next month? So certainly that's the key question for the market here today. But then again, we're starting off in onshore markets there to the downside with the CSI 300 leading the charge. We're slightly lower by 1/5%. We're watching the Chinex very closely here, as you mentioned, when it comes to the optical trade there. But the chips, at least for now, Capricorn Tech is leading lower by about 1% or more. Shanghai crude, as expected, is elevated here by close to 4%. Given what we've been seeing with oil prices, these kind of sweeping demands from the U.S., from Iran in the last 24, 48 hours is certainly leading to, of course, more of oil prices staying a bit more elevated. Copper, as we talked about, also tracking higher in Shanghai after we saw the LME contract surge to a record here. Of course, there's still this kind of delay over what the U.S. is going to do when it comes to copper tariffs, right? So that leads to a lot of lingering questions about inventories and the like here right now, and certainly could really lead to some massive moves once we do get that decision. So we're watching, of course, the metal space in particular. Hong Kong's doing this here right now. We're pretty flat at the open. As I talked about before, that psychological 26,000 level, we might see if we can actually punch through that here today. But we're watching very closely what goes on, right? There's also this Hang Seng sort of review, not just what we see usually quarterly about what is included, but also just the methodology of the tech space, which I think has gotten the trading community quite excited. So we'll see what could transpire. Their consultation period has began on such proposals. So that's one thing to watch as well. HS Tech catching just a slight bit. We're pretty much flat, though. Of course, we're still waiting those Tencent earnings coming up. There was a good headline when it came to WorkBuddy. This is largely seen as one of the most popular AI assistants out there, which, of course, Tencent operates. So certainly that's one thing to watch coming up in the earnings. Of course, the CapEx spend, the like from, of course, these big mega cap tech players, though. But Alibaba is actually doing the opposite. We're up some 2% here. Meituan's doing okay as well. We'll be focusing on when it comes to the chip stocks, right? Because given all these financing deals that we got from Nvidia, they're tapping Wall Street for this $500 billion funding commitment to really expand this AI infrastructure build out. For the read-through when it comes to the China chip space seems to be negative, at least for now. We're also watching when it comes to the optical stocks in China as well, as we talked about, right? There's a lot of debate among the sell side about whether this ban on components from the U.S. Will actually transpire, right? And for the most part, we've seen the likes of Citi, from the likes of B. Riley overnight saying, that China component ban looks unlikely, just given how important that supply chain is right now. So you're seeing a bit of a mixed picture, but we are seeing a decent rebound in Dongzhi, Inalight, and Epto Tech here this morning. Also watching biotech, as Avril mentioned as well, we've seen a decent sort of few sessions when it comes to the biotech space here. And there you go, continuing on once again here with the likes of Wuxi AppTech up some 1%, Avril.
Yeah, I think the Wuxi earnings were sort of catalyst for some of these biotech names, talking earnings as well with regards to the Hong Kong and Shanghai hotels and how it returned to profitability in the first half of the year. And this was supported by strong performance at its hotels in Greater China and the US, as well as the continued ramp up of its European properties. Let's get more on the outlook for the business with CEO Benjamin Vuchot, who joins us exclusively now from California. So, Benjamin, I hear you're at one of the properties in California, but talk us through first. I mean, what drove the Greater China U.S. performance, and what's your sense of how sustainable this is going to be going forward?
Good morning, Yvonne. Good morning, Avril. Thank you very much for having me on the show. Indeed, I'm in Northern California. We're about to open Car Week, and our hotel there, which is called Whale, is hosting a motoring event, which is a highlight of the week on Friday. So I'm delighted to be here to talk about the results of the Hong Kong and Shanghai hotel for 2026 for the first half. And to answer your question, I think the return to profitability is a result of growth in revenue and EBITDA, and primarily really the growth driven by our hotel division. I think for the China show, you'll be happy to hear that the growth came primarily from our Hong Kong, Beijing, and Shanghai properties. The answer to your question is really that we're seeing luxury travel being more and more resilient. The travelers are coming back, international traveling back to China, to Shanghai, to Beijing, and to Hong Kong as well. And even in Hong Kong, where we're seeing our F&B numbers growing really even faster than our room revenue. I think this is a good signal. We're finally above the 2018 numbers by 7%, if you go back to the numbers. But more importantly, the EBITDA also is growing much faster than that. So resilience in luxury travel. Our guests want to spend more time, wants to spend more quality time, and really it's helping the overall results. As you know, our group in Hong Kong and Shanghai hotels is the owner and operator of the Peninsula hotels, but also the rest of the portfolio, which is primarily commercial properties in Hong Kong, is also offering a lot of stability, hence the good results for the first half.
How agnostic are some of these luxury travel trends and the demand, as you say, coming back to some of the macro concerns in the Greater China region?
Well, actually, in fact, particularly if we look at our Hong Kong business, we benefited a lot from the number of IPOs that were in the first half of the year. The return to celebrations, the return to a little bit more optimism. And I think that proves that there's a bit more resilience, also a bit more confidence, definitely, in this part of the world. The rest of the economic or geopolitical turmoil in the rest of the world, I think, is a distraction for sure. But one may say that we actually benefit a little bit from the stability that we have in Greater China at the moment, and definitely our business is benefiting from that.
Yeah, I mean, I saw that RevPAR, when you saw Shanghai, Hong Kong, Beijing, that went up. Europe was also good at the Peninsula hotels there, but you did see RevPAR actually decline in markets like Tokyo, Bangkok, and Manila as well. I'm just wondering, how do these numbers in any way affect your expansion plans moving forward, and what markets that you're a little bit more interested in expanding into later on this year, even the next few years?
Well, as you know, we operate 12 Peninsula hotels around the world. 50% of those hotels are in Asia, and the rest is in 25% in the US and 25% in Europe. I think the numbers are coming in the first half of the year in the rest of Asia is a little bit misleading. We had a very strong first half in Japan last year, which we had a little bit of a downturn in some of the F&B numbers in Japan, which affected the overall other Asia numbers. But the rest of the world is performing very well. In fact, we are embarking into a growth-oriented strategy. We spoke about it in the past, this perform and transform strategy that we've embarked on since the beginning of the year. And expansion is definitely on the agenda. While we're very, very comfortable with the number of hotels we have in Asia, we do see also some growth opportunities continuously in the US, more and more in Europe. And I think once we have a bit more clarity on geopolitical issues in the Middle East, it's an area where we are not present yet, but we have very, very strong ties with guests from. And in fact, we've seen the return of those guests to travel internationally, particularly in our European and US properties over the summer. So this is also quite comforting for the future. And we can say that we're cautiously optimistic for the second half of the year in that respect.
Okay, quite interesting. In terms of, I know it's interesting what you've been doing is incorporating more retail sort of elements into hospitality. And certainly that, when you joined the Hong Kong and Shanghai hotels, that was why they brought you in some ways. How are you looking at the progress so far in terms of, how do you measure that success? Is it purely just on a revenue contribution, or are you looking at other sort of metrics now, Benjamin?
I think bigger than retail, I think the importance of branding today in luxury hospitality has never been more important, in fact. And we see loyalty being drawn to guests wanting to stay in more than one property. We're seeing now multiple stays from those guests traveling to London and then to Paris when they fly from the US. And so the brand Peninsula is definitely a huge asset for the continued success of the group. And with that brand Peninsula, there's opportunities to grow also. We know you may see in Hong Kong the Peninsula boutiques that we have either at Hong Kong International Airport or in the hotels in Beijing and Shanghai and Tokyo and Hong Kong. This is an area where we sell our own merchandise, we sell our confectionery. We're about to hit the mooncake season, where we have our famous mooncakes installed as we speak. But also, I think realizing from a very, very long time ago, almost 5 decades ago, that hotels is a wonderful place also to host retail from other brands. The Hong Kong Peninsula which we're very excited about the reinvestment together with the Peninsula Tokyo that we got approval from the board last time. The hotel in Hong Kong was the first hotel to welcome luxury boutiques in Hong Kong 50 years ago, with international brands that grew out of the hotels eventually. What we're seeing now is the return of this, what I call destination luxury retail, offering really the combination of the presence of the retail brands, but also the hospitality savoir-faire, the hospitality know-how that the Peninsula can offer to those guests or to those retail customers. And that combination creates a very unique ecosystem. So it's no longer just beds or just restaurants and bars. It's also the retail arcades, the wellness component, and all the other ancillary things like the Peninsula Academy, which is a great program where we give the keys to the cities to the guests who come to visit it, and we create access for things that would be difficult to enter if you were not from the city. So I think the ecosystem of luxury hospitality is evolving, and the luxury side of it is very brilliant, and the Peninsula is at the forefront, I think, to embrace those new trends.
Benjamin, to your point, Peninsula has a strong brand legacy, but I want to know what more is being done to sort of court the next generation of clientele, the kids of parents, grandparents who are so used to the brand.
Right. Well, first of all, I think it's a huge compliment when people can associate a brand through multiple generations and refer to it as something that creates such a strong link. What we are seeing today, in fact, in hospitality and travel in general, is this multi-generational travel trend that we're seeing. The shift from owning products to spending more time with friends and family is definitely hitting positively luxury hotels like the Peninsula. So we are seeing really multi-generational stays, which really echoes this idea that maybe we created memories with our families through a wedding or grandparents, celebrating their silver anniversaries or whatnot. But we're also seeing now the next generation wanting to get access to that lifestyle, celebrating a little bit that lifestyle. I say sometimes that old school has never been so cool. Things that don't change are actually incredibly powerful and incredibly strong, and we take a lot of pride in building our future from the great past that has taken us to such great heights. But it's definitely something that one must be very, very cautious, and that's why we are very intentional in our strategy to retain what has made the Peninsula brand so strong, but also to incorporate the desires, the dreams, the requests that we get from maybe a different generation. But I think, again, we're very well positioned to embracing this, and this is exciting. You may have seen on social media some of our recent campaigns. Peninsula Time. Peninsula Time is a great innovation in luxury hospitality where you can check in as early as 6 a.m. and leave the next day at 10 p.m. And we marketed this not just to a businessman who may be very excited about this, but also to a younger audience. And I think that the number of hits that we got on Instagram and other social media platforms was very comforting that we're on the right direction also to capture a new audience.
It seems like you're targeting all sort of audiences, Benjamin. Can you tell us a bit more about what, this kind of resilience and luxury demand you're seeing in China in particular? Can you break it down for us in terms of the mix of customers that you've been seeing?
Well, I think as I mentioned, from a geographical perspective, we're very well covered around the world. There's no doubt that the outbound travel coming from China has been a little bit more muted over the past few years. We're definitely seeing a reversal of that trend, particularly in North Asia. That's something we're seeing now, in Japan. We're seeing it, of course, in our success in hotel in Hong Kong. I'm hearing places that we're not yet there, but I'm hearing also Korea is benefiting a lot from the resurgence of travel from mainland China. So there's definitely an appetite for travel, an appetite for experiences, but I think there's an element of trust that the guests are looking for. And the Peninsula, there's no better name than trusting name like that. And at the same time, bringing in new concept. We're going to be introducing in the fall some really cool and innovative concepts in F&B in Beijing. We're going to do something also in lots of many of our other properties. This is important to stay relevant, to stay attractive to new audience, and hotels, particularly in Asia. Hotels is a wonderful place for people to gather, to meet, to have fun, and we don't only cater to travelers, we also cater to the local community. And F&B and wellness is a great way to do that.
Yeah, I mean, I love how you transformed the Repulse Bay as well. So, Benjamin, look forward to seeing, of course, all those renovation plans there coming through. Benjamin Vuchot, their CEO at the Hong Kong and Shanghai hotels. Thanks so much for your time, sir. Coming up, we're going to talk about when it comes to this upcoming listing. Retail investors are lining up for a piece of China's robotics future. More on the buzz around Unitree's Shanghai listing next. This is Bloomberg. All right, retail investors have piled up into Unitree Robotics IPO, making it one of China's hottest listings this year. For more on what we're seeing in terms of demand, let's bring in our Asia Equities Deputy Managing Director, Balazs Pence here. And really, the retail sector seems to be really buying into this story here.
That's right. Over 5,000 times subscribed this IPO on the retail portion, which shows the excitement around Unitree, which a lot of people think is going to be the linchpin of the next phase of the AI revolution, the world's largest humanoid robots maker. And it's a really, really important company to China and the Chinese tech industry as well, which is showed by these state-owned companies, including PetroChina, lining up to take a part of this company. And we also have Tencent and DeepSeek as investors here. So there's a lot of excitement around this company, which shipped around 5,000 humanoid robots last year, which doesn't sound like a lot, but they are the biggest in the world so far. Their revenue rose fourfold last year, which shows that they're in this early explosive phase of their life cycle. So right now, a lot of people feel like it's the best time to get in.
What is this going to mean, Balazs, for the rest of the industry?
It's a really important signal. I mean, Unitree is, of course, probably the most famous humanoid robot maker. Everybody remembers the Kung Fu robots at the Chinese New Year festival earlier this year. But we have more than 40 robotics companies just here in Hong Kong in the pipeline to list. And there are a number of others in China as well. It really looks like after we saw the culmination of the kind of previous stage of the AI wave with the CXMT IPO recently with that massive IPO, the next phase looks like it's going to be robotics. And Unitree is just kicking off that wave with a lot of other companies coming up. And so if this goes well, we could see a lot more in this space.
Oh, I wish we'll see. We get live pictures of the listing ceremony when it happens. They better bring some robots on stage.
I'm sure they will.
To bang a gong or something, right? Balazs Pence, thank you. Our Asia Equities Deputy Managing Editor on the latest when it comes to Unitree. Okay, we're going to switch gears and talk a little bit more about the financial stocks here, because when we take a look at the region, bank stocks are actually staging one of their strongest rallies in decades as investors rotate their bets amid growing uncertainty around the AI trade. Let's bring in our Asia Equities reporter, Winnie Xu. She joins us for more. I know nothing as sexy as humanoid robots, but we got to talk about what's really driving this outperformance in the banks.
Yeah, but I do actually think this is a very amazing story. Now, just to put things into context, we're also seeing very strong performances when it comes to U.S. banks and European banks. But Asia really has a lot to tell. Wherever you look in Asian markets, financials are strong. Let's just start with where we are in Hong Kong, because Hong Kong financials, the gauge is in fact showing its strongest monthly performance since in about 4 years. And that's coming as yields looking attractive and also profitability is quite good with these very active IPO activities. But let's say, for example, in Japan, you have that Bank of Japan raising rates and that bets around that area also driving the Japanese bank stocks to really outperform. Then where Avro is in Singapore, we had very positive earnings from the likes of DBS and OCBC last week, and we saw that's being boosted by the very active wealth boom, and we saw record wealth fees as well as the stocks rising to their record levels last week. Now, a bit south, we have India, and that is also showing a bit more upside when it comes to that credit cycle because we're seeing corporates and retail all piling in for more loans, and that is also driving kind of some of the upside on that front.
Winnie, to your point, we've been seeing this rotation towards the financial-related stocks, China, Hong Kong, Singapore as well. Talk to us about the risk, though, that could perhaps cap this rally.
Yeah, so when you think about the key macro drivers, right, it is actually two things. One is just that rotation away from or diversification away from the AI trade, but also how we have less fears towards a potential rate cut. But we're seeing a bit of that reviving if you look at the U.S. jobs numbers from Friday, and that is why we keep a very close eye on what's going to come tomorrow with the CPI numbers, because if we see potentially that the potential of rate cuts to come, that can give tech stocks a bit more upside while it hurts the attractiveness of financials. And that rotation back into tech can be also possible if you look at how the prices, when you look at valuation, it's not that much more expensive compared to financials, but the earnings growth is actually a lot way stronger than financial stocks.
All right, Winnie, thank you. Our Asia equities reporter Winnie Xu there with the latest when it comes to those financials, and yeah, really outperforming tech in some days here. So certainly one thing to watch. Another check of the markets here right now. We've been tracking when it comes to Singapore, Hong Kong, and Kospi. Actually, the Kospi has now actually turned positive. We're seeing gains of 1% here. Taipei, though, still a little bit in the doldrums here today, relatively speaking. We're watching some of these Apple suppliers across the region as well. Certainly one thing to watch very closely here, given the interest that we have seen when it comes to this glass-centric iPhone, stays on track for its 2027 anniversary. So we're watching what that means for the supply chain overall. Tencent Music as well. We're watching very closely, of course, not just when it comes to Tencent earnings, but also Tencent Music reports usually on the same day. And we are actually seeing that stock surge ahead of those earnings. When it comes to the rest of the benchmarks here as well, this is what the rest of the benchmarks in China are looking like here today. We talked about Hong Kong. It's been pretty quiet overall, so to speak. And certainly when you take a look at what we're seeing here, Hang Seng is up, CSI 300, pretty much not much conviction. We're flat there as well, but we are seeing a little bit more tilted towards offshore here with 8 shares, Hang Seng and MSCI China, seeing some decent gains. Yields, though, are slightly in the red. Of course, there was that disappointing inflation report yesterday that did send yields lower by 1.7%. We're back above that for the 10-year here right now, but certainly a lot of questions of whether we are getting back into deflation when it comes to China as well. Shanghai crude, as we mentioned, given just the flare-up in tensions between Iran and U.S., these sweeping demands, a hardline stance from the U.S. and Iran as well, has certainly led to a lot of questions on what this U.S. CPI print is going to bring as potentially the next event risk out there this week. We'll have more on the next way in the next hour. You're watching The China Show. Welcome back to The China Show, second hour. We'll look at the HSI half hour into the session here right now. It is sunny skies. It's been a scorcher the last few days in terms of the temperature and certainly in the humidity as well. But yes, you're not seeing a whole lot of heat in this market here, at least for today. When it comes to stocks, it really hasn't been doing too much in terms of direction. Regionally speaking here, it really has to come down to the oil price, given this flare-up in tensions, crude prices that basically have rallied some 9 or 10% in the last few sessions or so. HS Tech now is in negative territory. Of course, the key thing to watch is going to be Tencent earnings later on this week, April.
Yeah, when it comes to the heat, not just in Hong Kong, that's certainly something we're very used to here in the Lion City. Take a look at some of these benchmarks in the region, how they're faring on a day where maybe there is a bit of caution when it comes to the Chinex against the backdrop of, what these AI hardware stocks are going to be looking like when you have a bit of a rethink when it comes to what's happening on the mainland. Aside from that, also the TAIEX is down, despite what we got from the likes of TSMC. Following on from those monthly sales numbers, Kospi is picking up a little, reversing what we saw earlier on in the session, and then Singapore, right? That's where the heat is. That is rising 1%. Of course, we were on holiday yesterday. This is really following through from a trend from last week where we had the banking stocks in terms of the earnings performance. They've all been doing really well and that upbeat performance forecasts. We also have, in terms of earnings, Yangzijiang, that's another stock that has been adding or helping to boost the STI today, but also against the backdrop of what you're getting out of these GDP growth forecasts for the Lion City. So raising the outlook to as much as 5.5% for this year, thanks to, you've guessed it, the AI boom. Now flip the board and take a look at commodities as well. Given these geopolitical rumblings, the hardline rhetoric that's coming out from both the US president as well as Iran, you're looking at oil trending towards the 88 handle and coming also against the backdrop of these tariff concerns that have propelled copper, or at least the LME copper, that is trading at that record level. You're seeing some green on the screen there. We are also watching gold at the 4,400 level thereabouts. Flip the board again, because the Japanese currency has certainly been one to watch, right? So we got the intervention well over a week ago. That was Thursday, Friday session. And following that, we did see that steep climb, of course, in the Japanese currency, but it has given up a lot of those gains, maybe some of this read-through as well, given what we're seeing on oil prices, given how this could impact energy as well as inflation in Japan, but looking very closely as well at some of the other indicators on the other side, the dollar, as well as data that's coming up later in the week, Yvonne.
Yeah, I mean, certainly when you take a look at the fortunes of the Japanese yen, certainly we've wiped out half of the gains since that coordinated intervention with the U.S. and Japan, right? So we slid as much as 1% on Monday. We are now past 159 per dollar here. And really, it just goes to show the limits, I guess, in some ways of what Scott Bessent has said, right? This whatever it takes sort of vow to rescue the currency. Let's bring in our Bloomberg Markets Today editor, Sam Unstead. He's here with us here. Yeah, we've wiped out half the gains already. It does show in some ways the coordination that we saw between the U.S. and China does have limited firepower.
Yeah. So, I mean, you have this one big moment, that comes through, but it's not something that's necessarily going to be sustained. If it is, we'll see what happens in the future, whether there are more interventions, but it's not a sustained moment, right? So what ends up happening is everything comes back to the fundamentals. So you start to think about the actual attractiveness of the yen, the attractiveness of the carry trade is still there. The volatility is still, very low. The interest rate differentials are still, where they are at the moment and still look very attractive. So you get this one pop, and then everything kind of comes back to the fundamentals, combined with, as you guys just mentioned, the dollar strengthening particularly over the course of the last few sessions, as you've seen oil prices go up as well. So everything is kind of moving against the yen at the moment.
Okay, what to next then? What are you looking at next for the yen?
I think what you're looking at now is the Bank of Japan. So we heard from this week that maybe there's going to be a sort of faster pace of rate hikes. In order to get some kind of sustainable move from the intervention, you need the Bank of Japan to sort of act relatively quickly afterwards. You need sort of a coordinated effort across the board. That hasn't really happened. When that next rate hike comes, that will be a big question now, and that will become the big question between September and October. But much more broadly than that, there's a lot of things that would need to change in order to make the yen more attractive and to kind of sustain that gain for the yen. We're talking the Federal Reserve, turning it maybe a bit more dovish than it is now. But for that, you're going to need inflation to cool down. And for that, you're going to need the war to end and oil prices to come down. And all of these things are out of the control, effectively, of not just the Bank of Japan, but Japan in general. And so, these coordinated moves, you may well see another one later in the year. We shall see. But again, if the fundamentals remain as they are, the likelihood is that it's only a temporary change.
Yeah, for the moment, we are seeing yen vol looking pretty low. So to your point, Sam, about what markets are really expecting here. Bloomberg Markets Today editor Sam Ernstead for us. Now, let's also talk more about other asset classes. Bring in Vivian Lynn Thurston. She's portfolio manager at William Blair. So, Vivian, today we are seeing, of course, maybe things are a bit muted, but what is your sense of, particularly for the AI trade, where things go from here, given how we've been hearing, you know, these big tech names, they're looking at financing, including the likes of Nvidia?
Yeah, I think the whole point about the AI trade, not just China, I think globally, is about the AI capex cycle. I think I talked about this in the past, that as long as the AI capex cycle remain positive or supportive, I think the global AI trade will continue. And that will impact positively both the Chinese AI stocks and also the Taiwanese and Korean AI stocks. But we have seen increased volatility in recent times for the AI trades, I think, across the globe. And part of it, I think, is the increased concern of the AI capex cycle. As every quarter goes by, you know, that kind of debate continues to become more topical. And the other, I think, catalyst on the negative side is the U.S. interest rate cycle. If U.S. raise interest rate, that tend to be bad news for growth stocks, tech stocks, and also emerging market stocks. And so I think those two factors, I think, remain the center of the future AI trade.
When it comes to how foreign investors are viewing markets such as South Korea and Taiwan, do you have a preference for one versus the other? I mean, it looks like the month of July, how painful it was for South Korea. You know, maybe there is more of a case for Taiwan than South Korea.
Yeah, from the fundamental perspective, Taiwan does have a more broad-based kind of a tech hardware ecosystem. Therefore, in addition to the largest foundry globally, you also have a very broad-based hardware tech, ranging from networking to testing to some infrastructure or PCB players. And in Korea, this will be more narrow, I would say, primarily based on the memory plays. So from the fundamental side, definitely Taiwan market should be a little bit more, I would say, healthy versus the Korean market. And then from the market dynamic perspective, as you correctly point out, that Korean market recently saw a lot of volatility due to the retail trading phenomenon, whether it's ETF, leverage ETF, or margin calls, or those retail purchase. And that, I think, is quite unique to the Korean market. So all in all, I think going forward, some of the trades has unwind. So we'll see how the fundamental continue to play out, because I think that remains the key. As long as the AI-related trades, whether memory, whether other hardware tech, continue to come up with a stronger earnings and better monthly sales, I think those stocks will continue to do well.
How do I look at the China AI trade now? It seems like investors are more comfortable getting into the Alibabas, the Tencents now, versus the pure plays. It wasn't so much like that just a few months ago, Vivian. But you're starting to see maybe the earnings of these sort of big cap tech. Maybe we're likely to see a bit more of that AI capital spending really in some ways transpiring and being monetized. And, you know, when you take a look at the adoption rates of some of these AI models in China and how low cost they are, you're starting to see a bit of almost like an inflection point where there is sort of this China AI play that's in some way narrowing the race with the U.S. So I'm just wondering how you look at it right now, especially when it comes to some pretty frothy valuations of some of the pure plays right now, too.
Correct. Yeah, I do think some of the internet companies in China previously, they were laggers because they were not pure play to AI. And especially depends on their core business, whether it's a core e-commerce business or core online gaming business. Some of them remain challenging because of the competition and high spending, for example. But now, given that a lot of pure AI trades, some of them in China, especially in Shinx kind of board, has done fantastically well. Some of them up 200%, 300%, or even more. And I think valuation can get a little bit frothy on some of the names. I do think investors start to kind of diversify away from that pure AI exposure and to look for something else that still have AI exposure, but maybe stock has been lacking or be penalized in some way. So that, I think, helped some of those internet companies, which start to see some recent recovery of the share prices. But I think going forward, their earnings still need to come through. So we'll see some of the earnings come through in the next few days. And then if the earnings continue to be more supportive or better than expected or not as bad as feared, I think those stocks will run more. Yeah. So, and I also think there's a dynamics between the global investors versus domestic investors, how they look into the Chinese stocks. I would say those internet companies tend to be influenced more by global investors liking or not liking of Chinese equities, and they become the Chinese equities proxies. So when Chinese equities underperform, that means global investors' appetite for those equities tend to be low, and those key stocks tend to be a reflection of that. So there's a degree of the flow dynamics as well.
When it comes to the fundamentals, I mean, to Yvonne's point about how some of these names are not pure play AI, talk to us about what investors want to see in terms of monetization. Given how, for the likes of Tencent, for example, the workplace buddy, that seems to be making inroads. So as an investor, what sort of metrics will you really be looking out for, that could propel the stocks of these mega cap Chinese names?
Yeah, I think at this stage, to talk about monetization, I think I would say a little bit early for a lot of those hyperscalers of China, given that I think the AI-related business still quite small compared to the major business. And then secondly, I think if you think about how to monetize a certain technology like AI in this case, I think you cannot separate the AI benefit to their traditional core business versus the pure AI benefit. Right? So we tend to look at purely how the new AI business generate revenue or return. But in some cases, I think AI also function as a very powerful tool to enhance the return and profitability of their core business. So if I want to think about monetization, I think I would think about both, more on a combined basis. Having said that, I still think we're still pretty early. If investors want to see very quick material positive monetization effect on those Chinese hyperscalers, internet companies, I think it'll be too early. This is actually even true for some of the global hyperscalers. And they already, I would say, ahead of the curve compared to the Chinese hyperscalers. Even them, I think the debate is still ongoing about how much and when they will start to see the monetization impact. I think it's a matter of time. I believe in that. But maybe it's too early right now to really pinpoint the magnitude of it.
Vivian, thank you. Vivian Lynn Thurston there, portfolio manager at William Blair, joining us from Chicago this evening. Thanks so much for staying up for us. Still ahead, we're going to talk Indonesia nominating a new central bank chief at a pivotal moment for markets. We'll discuss what the appointment means for policy, the rupiah, and of course, Indonesia overall investor confidence. Coming up next, this is Bloomberg.
All right, let's take a look at how the yen is faring against some of these major peers. Of course, the one that we've been keeping tabs of is dollar yen, now trending near the 160 handle, so pretty much erasing a lot of those intervention gains. And I think investors, traders here, really testing the resolve of both US and Japan financial authorities. Yvonne.
Yeah, I went on vacation and I came back and the yen was basically the same. It's like I missed the whole intervention in some ways. Yeah, certainly there's a lot of questions about what comes next. And I think Sam mentioned from our MLive team of just the fact that we need to really watch out for the BOJ moving forward. We've also heard from Japan's growth strategy minister saying that the government spending plans will provide a long-term boost for the yen. Speaking exclusively to us in Tokyo, Minoru Koichi also pushed back against market concerns over the nation's finances.
As you know, we had a very prolonged underinvestment, and based on the basic policy, which was approved by the cabinet meeting on the 12th of July, we would like to try to achieve a strong Japan's strong economy on one side, and on the other side, we would like to strengthen the fiscal sustainability. We think both are very important.
We are talking about consumption tax cuts on food and beverages. We're talking about having to spend still this year, next year. How do you fill that fiscal hole?
Yeah. I think I would like to stress the fact that this does not represent a retreat from fiscal discipline, and we are shifting from the rather, abstract concept of fiscal consolidation towards a framework that places greater emphasis on the more economically grounded and international standard concepts of fiscal sustainability and debt sustainability.
All of the spending right now that's expected, including the consumption tax cut, for example, that's raising concerns. Which tools does the government have available and funding alternatives if you're not going to borrow more?
We review both revenue and expenditures, and we also review, as I told you, some fundings and special taxation measures. Through this, I think it's not so difficult to secure 5 trillion yen.
Is fiscal policy right now in Japan, which is seen as very expansionary, going to be able to achieve that goal?
Japanese fiscal policy is not so expansionary as you think, because we put great importance on fiscal sustainability. So some people say that Japanese fiscal policy is very expansionary, but it is not true. We will stick to the fiscal sustainability. And as Prime Minister Takaichi stressed, the fact that regarding the consumption tax reduction on food and non-alcoholic beverage, she won't issue a new JGBs. So I think there are some misunderstanding. Under these policies, the public and private sectors will collaborate in bold and strategic investment in crisis management, which minimize a range of risks, and growth investment, which will enable cutting-edge technology to flourish. So we won't invest, for example, massive state money to produce mango or another fruits. We will invest in the fields, as I told you, such as AI, quantum technology.
If the BOJ hikes rates and the yen still weakens, how problematic will this be for the government? And could you reconsider perhaps some of the fiscal plans, which right now are thought to perhaps be destabilizing investors and market sentiment towards Japan?
I would like to stress the fact that Japan's fiscal position is improving. Responsible and proactive public finances is a policy aimed at strengthening Japan's supply capacity and productivity while attracting greater investment into Japan. As investment in Japan and yen-denominated assets increases, demand for the yen will naturally rise, as I mentioned. I therefore do not see responsible and proactive public finances as a policy that leads to a weaker yen. And on the contrary, I believe it can put upward pressure on the yen. Lastly, our aim is to achieve both a strong economy and fiscal sustainability in an integrated manner. Please believe me. That is the essence of responsible and proactive public finances and the core of this historic shift.
That was Japan's Growth Strategy Minister Minoru Koichi speaking exclusively to Bloomberg and our very own Sherry An. Look at how Asian markets are doing as we head to that break here. Not much direction really when it comes to the Hang Seng, and as well as onshore markets were flat on both of those. The Kospi is above water, but Taipei seeing a bit of pressure here this morning. This is Bloomberg. In some corporate news this morning, Bloomberg's been told that Intel is looking to increase the amount it's raising in a share sale to about $20 billion. Now, that's about 1/3 more than it was originally targeting. Sources say the chipmaker is poised to price the offering at around $95 per share or above. This would be Intel's first public share sale since it listed in 1971. Mark Zuckerberg has published a 6,500-word essay on artificial intelligence, emphasizing his belief that wider access to AI models is key to the industry's future. Meta CEO says he still supports open source AI and challenges the notion that concentration of power in a few companies can ensure safety. It comes as the company introduces a downloadable AI model that can run on a personal computer. Anthropic has formed a partnership with Macquarie Asset Management and Singapore Sovereign Wealth Fund GIC to develop AI data centers in the U.S. The companies say Macquarie and GIC will provide most of the funding, while Anthropic has agreed to cover any consumer electricity price rises linked to the facilities. They didn't share any details on planned spending, though, or the size of the projects.
Now, Yvonne, here are the movers as well. They were watching in the session. Some failure to launch when it comes to Chinese Long March rocket and how it failed while launching a communication satellite. So this is the second failure of the rocket family this year. We're talking about the Long March 7A rocket, and it appeared to explode about a minute and a half after flight. So you're seeing those stocks in focus, but also flip the board and take a look at some of the other movers. We did get the likes of Morgan Stanley. They expect to see things looking on the upside, topping estimates on the AI boom for the likes of Lenovo, Gigabyte, Asus Tech. So that's one tailwind that we're watching for some of these stocks. So they're mixed in trade today. And then the likes of Everglory following on from first half earnings. Profits surge. We are also seeing some chatter about Hong Kong listing plans. So that's another stock that's in focus in Singapore. This is Bloomberg.
All right, welcome back. Japan markets are closed today, so volumes are down. It's quiet across the rest of the region, and really maybe some time to give us maybe a chance to look under the hood. Let's bring in Anthony Stevens for some of the big themes in markets here today. You're looking at this sort of Korea versus Singapore trade now. What's going on there, Anthony?
Yeah, it's interesting to see how differently markets are playing AI, right? There's the really high octane version, which is the Kospi. It's been flying around a lot. It's up 50% on the year. It's starting to calm down a little bit as the excitement fades. But on the other hand, you have Singapore, which just increased its growth forecast. This is a second-tier AI play, and it's done fantastically well this year at a very high Sharpe ratio. Singapore's trading at a 4 Sharpe ratio, which is just mind-blowing. Maybe I'm biased because I studied there, shout out SMU, but STI is doing really well. Switch the board now to the macro, and we have an interesting phenomena here with both oil and gold rallying at the same time. That's really interesting because the dollar rallies when oil rallies, but gold has weathered the storm and is cracking on here as it tries to get back above 4,500. So watch for that for people to play commodities momentum. And that's going to be a really interesting dynamic heading into US CPI later in the week. Now switch to both the single stock movers, and it's a very interesting picture across the region. In Korea, you see Samsung, let's do the pharma first. This is the biggest move in the region. It's been a low-key outperformer. The HS Bio continues to rally, and today it's being followed by the Korean sector as well. This is a rotation away from AI. People want to stay in tech. They want to stay in innovation, but maybe not in the AI semiconductor plays anymore. And we're seeing pharma really benefit from this. Now switch the board again, and we can go into some of the other details in the region. So we have Samsung here doing all the heavy lifting for Korea. Korea is flat on the day only because Samsung is so strong. Taiwan, much better picture. You continue to see the AI server plays do really well, up 6% today on all chip. This follows on several limit up moves yesterday. And just take a look at the China optical space for a quick second. What's very interesting here is that the US optical space fell on anticipation that Chinese competition would continue. But the Chinese are not buying that story, and this space is getting sold by retail quite hard. Now, the final board of the day is a sector we've been talking about the whole day, which is the oil space, right? Oil had a really big move, and it was interesting to see US oil stocks follow through. And one of the reasons for that is inventories in both the US and China are on the low end of things. Whether you talk about the strategic reserve in the US or the teapots in China, they need to start buying oil in the back end of the year. And there's a kind of a hockey stick effect here in the oil stocks across the region that are having big moves alongside spot oil for the first time in a long time since the war started.
All right, there you go. Very comprehensive look at the markets from Anthony Stevens. Can't beat the Singapore education system, if I may say so myself. Bloomberg Markets reporter Anthony Stevens for us. Now let's take a look at what the Indonesian assets are doing, because we are seeing some of that pressure coming for the JCI today, and you're still seeing that weakness, maybe a bit of a reversal from what we saw just a day ago after the Indonesian rupiah rallied after President Prabowo nominated Destry Damayanti to head Bank Indonesia. The move is being seen as a step toward restoring investor confidence following the surprise resignation of Governor Peri Warjio. Southeast Asia economy reporter Claire Jiao is with us now. So Claire, markets have been so concerned about the idea of, how much central bank independence is there in Indonesia. Does this help allay some of those worries? What is the market reaction that we've been seeing so far?
Yeah, this is probably the best case scenario for markets. Ibu Destry has long been the favored candidate ever since the unexpected resignation of Governor Peri Warjio. She's a longtime economist, a banker, but more importantly, she's a deputy of the former governor, which means she's steeped in that central bank history, in the policy. She's helped steer Indonesia through that COVID crisis, so she knows what the mandate is that she has to uphold. That's crucial at a time when investors are really wary about uncertainty in Indonesia. Not only do you have the unexpected resignation of the central bank governor, the finance minister last year, but you've also had a spate of unpredictable economic policies around commodities, spending, taxes. So it would be great to have this steady hand back in Bank Indonesia. However, and this is probably why there's still some weakness that we're seeing in the rupiah, one tension still remains, which is that tension between Bank Indonesia wanting to be independent and also the president and the government wanting them to support more of their growth push, and what that means now for policymaking under Ibu Destry.
Yeah, there's pressure to support Prabowo Subianto's growth agenda. What do we know about, the kind of Bank Indonesia we might be seeing under Ibu Destry?
So far, Ibu Destry has repeated the same script as her predecessor, which is she would uphold the core mandate of preserving the currency stability, intervening in markets, and potentially hiking rates if needed. However, under the previous governor, those measures weren't taken well by the government, as said by people familiar in our reporting. They don't like the tighter liquidity. They don't like that bond yields have risen. They don't like the rate hikes that are potentially hitting your bank lending, your economic growth. And they want that to be closer to 8% versus the 5% that we're seeing now. Whether or not the government will let up pressure, maybe we'll get some clues when President Prabowo Subianto gives his State of the Nation address on Friday. We'll also have that Bank Indonesia rate decision on Wednesday next week. That's going to be closely watched. One thing that will help Ibu Destry is the rupiah's recovery, like relative recovery, that it's back below 18,000 against the dollar, and that could ease up pressure on her to raise the rates again.
All right. Claire, thank you so much for running us through the nuance as we watch very closely, of course, what's come out of Indonesia based on just the personnel involved, but policy trajectory as well. Bloomberg Southeast Asia economy reporter Claire Diao for us. And you can rewatch that on our video hub. Subscribers can explore our live streams, news, and interviews there as well. Check it out at bloomberg.com/videos. This is Bloomberg.
Well, China has condemned India for formally announcing names for 27 sites in a disputed region, just as the two sides seek to stabilize ties after years of border tensions. Let's bring in our China correspondent, Min Lo. She's been tracking the latest on what kind of led to this latest spat.
Yeah, this is like an old wound that keeps opening up, right? The 3,000 plus kilometers borders that is shared between the two sides. And the latest spark was because India just last week had announced a list of 27 names of features in this disputed region, which China calls Jiangnan, which is South Tibet, and India calls Arunachal Pradesh. And remember, China was the first that started this naming practice. Back in 2017, they have released by now about 6 batches of names, naming some 112, I think, features in the disputed region. And both sides have been slamming each other over this. India, for example, has previously said that this is a mischievous act from China to create these fictitious names, and they're saying that this time they are naming the features to ensure accurate recognition and also to raise public awareness of the features. Meanwhile, China has said that this is an illegal and invalid act by India, and it doesn't negate the fact that Jiangnan belongs to China.
Min, this is coming at a time where both sides are trying to stabilize ties. Might this derail the progress that's been made?
Yeah, so this is really quite a delicate balancing act, right? Things have improved, particularly after Modi and Xi met last year at the sidelines of the SCO summit in Tianjin, and we had seen some pretty concrete measures like the loosening of visa restrictions, resumption of cross-border trade, increased flights between the two sides. But it also reveals that the underlying issues like the border tension is still very intractable. I mean, this is something that dates back to 1914, to the McMahon Line that was created by the then British Foreign Secretary of India at the time, and China was never a signatory to this agreement, and it's always viewed this as a legacy of colonial aggression. And a part of that stabilization could also perhaps be attributed to, Trump's tariffs that pushed the two countries together. But so far, if you look at state media, Global Times published an editorial, and the tone has been quite balance, with the editorial calling for both sides to work in the same direction, saying that China remains committed to stabilizing ties with India. So it seems like there is some intention to at least localize this conflict and ensure that it doesn't spill over to the broader ties.
All right, Min, thank you so much. Bloomberg China correspondent Min Lo. Now, some of the world news we're following as well. Gautam Adani has won dismissal of U.S. fraud charges tied to allegations of a $250 million bribery scheme for solar contracts in India. A U.S. judge dismissed conspiracy, securities, and wire fraud charges against Adani and his nephew Sagar Adani, preventing the government from bringing the case up again. The ruling marks the end of Adani's U.S. legal troubles. China has ordered anti-dumping deposits on pecan imports from the U.S. and Mexico. Starting Tuesday, importers of U.S. nuts will have to pay a deposit rate of 54%, while those buying from Mexico face rates of at least 18%. Beijing earlier said pecans from both countries were being sold in China at unfairly low prices, and the decision comes as officials prepare for Xi Jinping's planned visit to the U.S. next month. The SEC has eased the path for data center operators to issue asset-backed securities. In a letter to a law firm late last month, the agency said data centers are physical infrastructure assets, not financial assets such as loans or leases, meaning some securitization rules will not apply. The move could help unlock more funding as Wall Street looks to finance a historic build-out of data centers and AI infrastructure. Yvonne?
And coming up, Hong Kong's status as a leading financial hub is facing a new test as Beijing's cross-border crackdown raises fresh concerns for wealth managers and investors. A closer look next. This is Bloomberg.
Now, we're also watching what traders are expecting in terms of rate hike odds out of the U.S. Central Bank. And of course, there's this backdrop of the fresh spike in oil prices, given the developments between the U.S. and Iran. That is also part of what's prompting September rate hike odds to now come back to the fore. And that is a coin toss based on what the money markets are telling us. Of course, we also had some commentary from the Cleveland Fed President, Beth Hammack, talking about how some number of rate hikes may be needed. So more of that hawkish rhetoric that's coming out from some of these U.S. central bankers, Yvonne.
Yeah, she is an FOMC voter. She is also one of the few that did dissent in the last meeting. So certainly you are seeing some of the hawks come through and start talking a little bit more about the number of hikes needed to actually bring inflation back to 2%, of course, leading up to that CPI print coming up later on as well. So a lot of focus on that. We also talked to the CEO of State Street Investment Management and saying that the U.S. economy remains in good shape, but they're keeping a close eye on signs of weakness in the labor market. Ye Xin-hung told us the current picture should keep the Fed on hold for the rest of this year.
We think that the economy is in pretty good shape, although from our perspective, we believe the Fed really should hold steady on rates, and that's what we're calling for the balance of this year. But to the extent the Fed does move, and it's already indicated it has a more inclination to move faster, but gradually, we think the economy is robust still, but at the same time, where our worries are on the labor market, and so that's why we view interest rates being steady is the better case.
What are you so concerned about with the labor market? It's been kind of this no hire, no fire paralysis, really, for a while.
Exactly. And, you know, I think with the Friday report, it showed the labor economy being a little bit weaker. It's not a really strong source of inflation. And it's really that inflation picture that guides us to say this is not a time to be raising rates.
You know, there's a big discussion right now in the Federal Reserve and, frankly, in markets about artificial intelligence and how inflationary it's going to be versus the productivity boom that a lot of people are talking about. We're seeing, for example, the idea that you are seeing growth continue to accelerate even with some of the inflationary components tied to labor, for example, come in. What are you seeing at State Street in particular of how you're deploying some of the AI tools, the efficiency versus the cost?
You know, I think it is still early days for a lot of companies. I mean, clearly, every single company is investing heavily, as we are at State Street. Where we see tremendous opportunities is with, you know, very significant processes, data-intensive, sometimes very manual efforts, enormous efficiency gains. But we also see revenue opportunities, too, as we think about streamlining our investment process, post-trade, if you will. And then also customizing to clients, being able to provide what we do for very, very large institutions all the way through to individual investors.
We've seen already the financial industry contract a little bit on a headcount front. I just wonder from your vantage point, how you think about the growth of State Street as it surpasses $6 trillion and its footprint, its headcount footprint, in response to the greater efficiency that you can do? Is it just grow the assets by keeping the footprint the same? Is it potentially shrinking the total size of the employee base versus the overall assets?
You know, we see AI as just an enabler, enabling our people to be able to do more. And so we don't see this really as a headcount reduction play, but more so a benefit to being able to serve our clients even better on a global basis.
State Street Investment Management CEO Ye Xin-hung speaking with Bloomberg Surveillance. Now, of course, we also watching developments out of Hong Kong, and its competitiveness as a financial center could soon be put to the test. The city is widely expected to approve a landmark tax reform that's designed to attract overseas asset managers. Under the plan, taxes on certain fees for firms and even Hong Kong-based employees could be reduced to zero, Yvonne.
Zero, yeah, that's quite attractive, right? If you're a hedge fund manager that's looking to move into the city. But it comes against a different backdrop, right? When Beijing is tightening its cross-border crackdown as it gets serious about its global tax hunt. And certainly that raises a lot of questions in terms of the private wealth sort of industry. Let's bring in our Bloomberg opinion columnist, Julie Red. She's been tracking all this. And this sort of is putting Hong Kong in a bit of an awkward position right now. Just kind of tell us what these opposing forces tell you.
So on the one hand, here's my bet. Global markets, they will do very well, prime brokerage, et cetera, because if this landmark tax reform gets passed, and it's very likely that it will be by the end of this year, what it means is that hedge fund managers, private equity, like analysts, whatever, the bonus that they're getting is not going to be taxed at all. So there's a lot of incentive for global funds to move to Hong Kong, right? And that will be great for traditional investment banking services. But on the other hand, private wealth management divisions, they're not likely to do as well because China is really serious about this global tax hunt. And with the help of a common reporting standard, it's going to be harder and harder for Chinese to hide their assets overseas. And what it means is that billions of dollars of unpaid taxes, they will have to cough that money out. And where is that money coming from? They will have to liquidate some existing assets, which means that the total assets under management managed by private banking units, they will have to shrink, right? Because their clients have to somehow cough up the unpaid tax bills.
And we know it's retroactive, too. I think some of the things have come out.
Yes.
What does it mean for Hong Kong? Does it have the policies, the toolbox in place to blunt sort of the impact from China then?
So I think that's why it's very important for Hong Kong to pass the landmark tax reform. I mean, professionals like us, we're not going to like it because when the hedge fund people come in and they're not paying any taxes on their $1 million bonuses, we're going to be priced out. But unfortunately, I think that's kind of necessary because China is unfortunately taking away a big sugar bowl, and you have to find a high somewhere else. And this tax reform is very important.
So overall, how is this likely to shape the finance industry?
I think since the global financial crisis, private banking in Hong Kong has been doing very well, right? In part because China's economy is doing well, and that has churned out a lot of billionaires. I think that segment has probably peaked. On the other hand, traditional investment banking, for instance, capital raising, IPOs, sales and trading, prime brokerages, they are likely to do quite well because of enhanced trading volume.
All right, Julie, thank you. Our Bloomberg opinion columnist, Julie Ren there. Make sure to check out her column today. Hong Kong's low tax era is getting a reality check. And of course, you can also get an insider's guide to the money and people shaking up the finance hub in our Hong Kong edition newsletter. That's out every Thursday. You can sign up by scanning the QR code just right there on your screen there, or just visit the website, bloomberg.com/newsletters.
Aside from that, Yvonne, we're of course paying attention to the broader market moves on a day where things are looking quite muted. It's interesting overall. I think investor focus is not just maybe on the US inflation data that is upcoming at the time where oil prices are trending upwards, but also earnings. You think about Tencent to come, right? Already we're seeing some of that optimism maybe because of the headway that the likes of Tencent has been making on its workplace buddy. So tech is certainly in focus this week at the start of the Chinese earnings season. Now, aside from that, this is the other stock that we're also watching. And GM is said to be nearing the sale of half of its planned battery venture to SDI. You're seeing that stock on the back foot today. Flip the board, take a look at some of the healthcare stocks on the Hang Seng, the biotech names, of course. We've been seeing the gauge of them on a 6-day of wins. And I think it all kind of had a catalyst in the form of earnings from last week from the likes of Wuxi. And then things have been looking quite positive since then. I suppose partly to do with investors looking for alternatives at the time where maybe that rotation into mega cap names still looking a bit tentative. So maybe the hunt is on. When you look at the likes of the biotech names, they're all in the green today. Now, flip the board and take a look at how Tencent Music is also faring ahead of the earnings scorecard from its parent. So we're seeing that green just ahead of it, set to report earnings later today. We'll see how that informs perhaps some of the optimism as well for Tencent overall. A quick look at what we're seeing in the copper-related stocks on a day where we are watching out for these signs of perhaps caution in terms of does this delay in the tariff decision when it comes to copper actually make the risk of repricing even more of an issue. You're looking at copper LME at around the 14,180 handle. Copper-related stocks are on the back foot today as well. Let's take a look at how the region's benchmark is faring. You're looking at it flat, pulling back from session highs. And of course, Yvonne, one thing that we're watching as well, central bank decision making.
Yeah, could be as interesting as that MSAP chart, right? It's expecting no change from the RBA later on today, but we're still checking Aussie assets here. Given just the recent momentum around the Aussie dollar, right, that we've seen in the last month or so, can we continue that? Largely expected to do nothing, but then again, are we going to get a bit of more hawkish commentary to kind of anchor those rate expectations and inflation expectations? So certainly that's one thing to watch very closely here. But is that going to really move the needle today? The RBA on the Aussie may not be here today, according to some of our MLive team. We have plenty more coming up. Stay with us.